Hello, this is Bill Scheid from the Systems Lab, and in this video we are looking at Monte Carlo simulations for the PRX 3-minute automated systems. In a recent video we took a look at a backtest of the PRX automated system that trades GBTC plus ETHE on a 3-minute time frame. The numbers are quite impressive, a total of 401.3 R with an SQN of 4.8, which by Dr. Van Tharp standards would mean that this is an excellent system, and all of that on a maximum drawdown of only minus 20.5 R. Now, backtests are fantastic, but they are only one stage in the research and development process for any trading or investing system, and of course they do have some inherent drawdowns. So whenever we research a system, we always take a look at Monte Carlo simulations, which is the topic of this video. So on this screen we're looking at Monte Carlo simulations generated by a tool called Market System Analyzer. These are the same backtest data that we were just looking at a moment ago. The data do not include slippage and commissions because they vary for everyone, from trader to trader, country to country, but we do have the leverage set to 2x limitation. In other words, a 50% margin requirement. That is fairly typical for GBTC and ETHE, and we do want to put those limits into the Monte Carlo simulation. Otherwise, it would assume that we have unlimited leverage, which is typically not true for many traders. So on the left, in the graph that we have here, we have maximum drawdown on the vertical axis, and we have our position sizing algorithm on the horizontal axis. Position sizing is fixed fractional, and we have a variety of levels that we are risking here. A few points of interest: if you were going to use this position sizing algorithm and risk 1% per trade, your maximum drawdown would be just a little bit more than 22%. That's the point where the curve crosses the 1% line. If you were going to risk 1.5%, you would be closer to 25%. And as we go up, it kind of levels off because we run out of margin to buy full-size trades at a larger risk. Over here on the right, we have fixed fraction position sizing again on the horizontal axis, but now we have net profit on the vertical axis. So this allows us to say, well, if we're going to have this much of a max drawdown, what would our net profit be? And here we're starting with an account balance of 100,000, hypothetical account balance. The 1% number gets us about a net profit of somewhere in the 1.1 million range. 1.5% gets us just a little bit shy of 1.4 million, and 2% gets us around 1.5 million. So this is a good way for us to be able to see the risk versus reward at various position sizing algorithms at various risk levels per trade. Now on the next screen, what we have here is a full Monte Carlo simulation based on 1% fixed fractional risk. Again, we're using leverage set to 2x and a starting account balance of 100,000. On the left here, we see that the average annual compounded return is 62.5% on a worst case drawdown of 21.6%. So this roughly matches what we were looking at the last screen. So that's some good corroboration there. We see on the right side what the Monte Carlo curve would look like. So the blue trades are the actual backtest sequence, and then the red line is the upper 95% confidence limit, the green line is the lower 95% confidence limit, and the gray line is the average. So we have a nice looking slope up and to the right, and we can see that for the last half, roughly last half of the history, the system has been performing above average, which is excellent, and that also aligns with our other research on this system, which you can check out, of course, in some of our other videos. This is Bill Scheid from the Systems Lab. Thank you very much for watching, and happy trading.